Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt. Look at the week's financial news. They can be a bit confusing, misleading, and take you, of course, up to make it actionable, understandable, and clear. What a week, and therefore what a show. We've got fascinating data. I suspect only data this podcast will discuss. Of all the financial podcasts that could be listened to across the globe, I have a suspicion I'm the only one that will be talking about Vanguard ETFs and their distribution amounts for the end of the year. That's right. We're getting out of the casino. We're caring little to none about price action, and we're caring a lot about distribution amounts. We then look at why Vanguard, in so many ways, keeps getting better despite some of their foibles. They keep lowering cost. We will discuss how and why and where. I then play one of our favorite games on the show, So You Want to Be a Stock Picker. And we'll look at Apple and NVIDIA and see if you want to be an actual stock picker, because guess what? It's hard. And then because so many of you enjoy Peter Mallouk's data, we went to the well and found all sorts of interesting Peter Mallouk data, some of which kind of blew my mind. So I suspect it'll be revelatory for you. At the top, let's talk about Vanguard distribution announcements. As you know, it's the most wonderful time of the year. It's when Vanguard announces their distribution amounts across funds for Q4, their exchange traded funds. Now, why does this matter? Again, this is the only podcast in the globe that will discuss this. This is one of those preview moments where Vanguard issues, before the payments come in, dividend payments, what the amounts are expected to be. So for most investors, we're only thinking about price action. We're kind of in the casino. You ever heard someone say, hey, how'd you do this year? And they're referencing stock market returns. And what do they say? Well, I was up 20%, or I was up 10%, or I was up 12%. What exactly are they talking about? They're talking about price action. They're saying the price of that ETF has actually risen, and they're counting that as an increase, as a return. You know what I like to do? Forget all that stuff. Let's look at what sort of increase have we received Q4 of 2024 to Q4 of 2025. And we'll look at one of the famous ETFs, VOO, Vanguard's S&P 500 exchange traded fund, in the fourth quarter of 2024. This ETF paid out $1.73 per share. This quarter 2025 paid $1.81 per share. So a nice little increase. On the foreign fund side, we had some big old moves. So VEU, if anyone here knows what VEU is, I'll be impressed. VEU is the Vanguard, they call it the FTSE, FTSE All World XUS exchange trade fund. It paid out $1.33. Now that probably means nothing to you, because guess what? When I saw it in a vacuum, it meant nothing to me. But a year ago, quarter over quarter, it paid out 94 cents per share. Again, so this quarter, it pays out $1.33. A year ago, it paid out 94 cents. That is a move. Now, how in the world are these? I thought international stocks were just horrible and no one wanted to touch them and they're not worth your time. And don't you know America's the land of innovation? How in the world did this investment pop that much on a distribution cadence? How would it do that? To go from 94 cents to $1.33? 41% increase year over year? Currency. A lot of the tailwinds or headwinds from dividends in the international space have a lot to do with currency. So the US dollar depreciated during this time, and so it really makes those US dollar denominated dividends really pop. So why do I like this exercise? Why do I, since I'm the only person in America that focuses on this? This is farming. This is not speculating, because these dividends, they seem to come irrespective of price action. Of course, price action there's a correlation, but it's not that tight. It's really not that tight. So I'd encourage you, if you got extra time and you need help to fall asleep at night, go ahead and Google it. Vanguard end of year dividend expected amounts, something like that. The Google machine will take you there, and look at the year over year increase in some of these dividends. So when someone asks you, this will be great Christmas party conversation, you'll get a lot of weird looks. So how'd you do this year? Well, my dividend payments on my exchange traded funds from Vanguard are up 40% on the year. That'll get them. That'll freeze them out. They won't know what to do with that one, I guarantee you. So maybe not, but just if you're looking to cause trouble, you can do that. And then, team, Vanguard Group. The Vanguard Group lowers cost, and they lowered cost again. We'll stay in our little sandbox of VEU, that ETF we talked about, that exchange traded fund that had its Q4 2024 to Q4 of 2025 increase over 40%. The cost of that fund historically was 0.07%. Now that probably means nothing to you because it means nothing to me. When I go to 7-Eleven and I want to buy a treat or a snack, a Twix or a Reese Sticks, whatever your favorite, sometimes Reese's Pieces, I don't know. But and so if they, 0.07%, no one's thinking like that. I don't even know how to think like that. But you know what? If you invest, let's say $1,000, and if you wanted to find out what that would cost you, what do you think it'd be? What do you think it'd be? $1,000. You invest at 0.07%. What do you think it cost? 70 cents. 70 cents. Did you know, listener, that this year that fund had its expenses drop almost in half? That fund now costs 0.04%. Vanguard does this. Another fund, VXUS, it's almost identical. It's an international ETF that I recommend as well. It went from 0.08 to 0.05. And then VT, my Vanguard Total World ETF, one of my favorite solutions, it dropped from 0.07 to 0.06. Vanguard is dropping these. Dropping these. And if you really want behind the scenes info that no one knows about, did you know that the Securities and Exchange Commission dictates how you can advertise expense ratios? That kind of police officer for the investing space. Did you know that if you read the actual annual report for VEU or VXUS or VT, that the expense ratio should be advertised as negative? Listener, you are getting paid to hold these funds. Paid. Now you might say, well, how in the world is that, Robert? How in the world? Did you know there's something called securities lending? All these ETFs do it. A bunch of other companies do it too. But when they do securities lending, you know who gets the money? The fund. Schwab gets the money. BlackRock gets the money. They remit it to the parent company. At Vanguard, when they do securities lending, which is a almost no risk thing that's fully collateralized with cash, short sellers and others will borrow these securities and return them. It's just a way to earn income. These funds do it. The funds generated from securities lending at Vanguard funds are remitted back at the fund level, meaning your expenses for the year can be negative, meaning you got paid to hold these funds. This is the magic of the Vanguard mutual fund structure. And you might say, well, if a deal sounds too good to be true, Robert, it probably is. Well, just listen here. At Vanguard, who owns the shares? And most other corporations, a whole host of folks own the shares. Who owns the shares of Vanguard? The funds themselves. The funds themselves own the shares of Vanguard. So the interests are pretty aligned. When you see all these expense drops, you realize, oh, yeah, this is for the benefit of the funds because the funds run the show, which means you and I run the show. It's kind of a credit union or a country club for investing, but they keep hammering expenses down. And then Vanguard, they let out this announcement in actually February of this year. May 1 of this year was Vanguard's 50th anniversary, but there's a John Bogle quote about why costs matter. I'm glad they got back to Bogle. that old-time religion. Give me that old-time religion. Give me that old-time religion. Well, here's Bogle with some old-time religion. He says this: in investing, realize that you get what you don't pay for. Whatever future returns the markets are generous enough to deliver, few investors will succeed in capturing 100% of those returns. Simply because of the high cost of investing, all those commissions, management fees, investment expenses, yes, even taxes, so pare them to the bone. That is our friend Jack Bogle giving us great info. So a lot of great Vanguard info. Now check this out. Oh, a couple of these hurt my head. Peter Maluk, one of our favorites. He says, are you ready to have your mind blown? I am. Check this out. Since 1989, money invested when the market is at all-time highs has actually outperformed money invested on any given day. What? And he's got a chart for us to prove it out. Let me read that again. I had to sit with this one. I know my listener base is intelligent enough to handle it. Since 1989, the year Providence Christian School was founded, money invested when the market is at all-time highs has actually outperformed money invested on any given day. Over a one-year period, the all-time high was 13.5% versus 11.9%. Over a three-year period, you earned 44% versus 39%. And over a five-year period, new all-time high, you earn 82% versus 74%. Well, how is this possible? Because you can keep reaching all-time highs. And the any other day thing on an upward moving market, the all-time high math actually works out. Can you believe that, listener? Money invested in the market is in all-time highs. It's outperformed money invested on any given day from 89 to 2025, 89 to 20. Now, would this be true in the 30s or maybe in the 70s? I mean, we could cherry pick this and kind of mess this up, I bet. But what's the lesson? Just invest. Don't overthink this thing, guys. The best time to invest is now. At any given moment, now people will tell me, Robert, what about 1988 Japan? Didn't they just get back to break even? Or what about 1929 America? It took till 1954 to get back to break even. Lots of stock markets take forever. I understand that. I hear you. Follow Peter Maluk. The data in its simplest understanding is that you should invest now and don't worry about it. Another great fact on diversification. Over the last 93 years, 4% of stocks have driven 100% of U.S. stock market wealth creation. The other 96% are break even. Again, let me say this one again, because I think if you want to be an investor, this is going to really make you like index funds. Over the last 93 years, 4% of stocks have driven 100% of U.S. stock market wealth creation. The other 96% break even. That's the Journal of Financial Economics. Sounds like a legit journal. That makes me scared to pick stocks. I have more data on, but every now and again I need to be reminded of how scary it is to pick stocks, because wouldn't you know it, even yours truly gets tempted. That's not a fun game. I don't want to play that game. Needle in the haystack. It's too hard. It's too hard. And then Mr. Maluk with a third data point. I think this one is also just highly instructive. He says this: the average S&P 500 total return is 10% per year, but the stock market has only performed within 2% of that number in 4 of the last 97 years. The highest annual return is 53%, the lowest negative 44%. The lesson? To get the average return, stay diversified and hang on. Let me just say it again. So people say this all the time: oh, that stock market will do about 10% a year. Or they'll say, oh, it'll do about 9% a year. And when they say it, they imply it's pretty steady, right? Peter Maluk is saying, no. It's only performed within 2% of that number, that 10% number, in 4 of the last 97 years. And there's a histogram showing, they're all over the map, these returns. All over the map. So this happens sometimes. I'll say, hey, someone promises a fixed rate deal. Hey, we'll give you 8% fixed, 10% fixed, a pref, they'll call it, in a private deal, private placement. What I realize is, gosh, if the S&P 500 is doing 10%, but it's as volatile as I'll get out, it's going to be tough to make good on that promise. Doesn't mean they can't. People do it all the time. But it should give you an ounce of suspicion when someone is promising fixed returns that approach the annual return of the S&P 500 with a ton of volatility. Because behind the scenes, behind the curtain of the Wizard of Oz, to get that 8%, to get that 10%, something's got to go right. Very right. And they're trying to smooth the ride out for you and give you those fixed returns. Be wary, listener. Be wary. You should be highly suspicious of anyone promising fixed returns above U.S. Treasuries, above the 10-year U.S. Treasury. And when it starts approaching what the S&P 500 does, I'm getting a little nervous at that point. And continuing our series of So You Think You Want to Be a Stock Picker, one of our favorite games, I'll tell you what has been inculcated in my mind lately is that Apple's old hat and NVIDIA's next gen. Apple's kind of just fuddy-duddy, good luck to you. Maybe it'll go in the dustbin of history because it's not embracing AI. And NVIDIA is what's next. But let me tell you how hard this is. And I just think it is. In the last 6 months, Apple's up 39.57%. That shocked me because I was kind of told that it was toast. It didn't have a shot, which beats NVIDIA's done well, beats NVIDIA's 24%. NVIDIA in the last month is down 6%. Down 6% NVIDIA last month. Again, that's a short time frame. And last month, Apple's up about 2%. Now, how is it, listener, that a company with such bright growth prospects like NVIDIA and a company that's as fuddy-duddy as Apple, how is it that the stock price of one outperforms the other? It's a tough game. The stock market in the short run is an expectations game. As the old saying goes, in the short run, it's a voting machine. In the long run, it's a weighing machine. So I find it quite difficult. If Peter Mallouk didn't convince you about how few stocks contribute to the, remember 4% of stocks have driven 100% of the U.S. stock market. I'll tell you what, just the divergence of companies from month to month, if you're trying to invest, it's tough to hold on. I don't know how people do it. Actually, I do know how they do. I don't know how they do it, but the Spiva report tells me 95% will fail over a 20-year period. That's a pretty high failure rate. And then in closing, we'll close it off. Interesting data on Google searches. Google has all this data. This is from Bloomberg and Google Trends. The Humble Investor by Daniel Rasmussen, I guess, elevated this 2025. The search spike for the theme of .com was in February of 2000. Once that spiked, 12-month return from that spike, it was down 90%. This is a funny one, Dogecoin. Do you remember Dogecoin? Maybe it's in the dustbin of history. I've not followed it lately, but it had a search spike in May of 2021. It's down 80%. 12-month return, 80% from that. So as efficient as I think the market is, there are anomalies all throughout. So you got to be wise as serpents, innocent as doves, and focus on what you can control. We know what that is, keeping those costs low, that investing simple, and that time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.